Hi, good afternoon, everybody. I hope you can hear me. Just do a quick sound check. Just write in the box again, in the question box, if you can hear me clearly before going on. Maybe you can hear me. Okay. Here's me. Yep, great. Thank you. Thanks for the feedback. Great. Thank you. Great. Okay, let's get going. Welcome to this week's webinar. This week we're discussing risk management. I talk about the 3 S's, the structure, the spread, and stop loss. So that's the topic. If I go quickly through the agenda, obviously we're going to focus a lot on risk management, but obviously as introduction, we're going to talk about portfolio management because that encompasses portfolio management. And as we do with every webinar every week, this webinar is being recorded. So those of you that are on the webinar will be getting the presentation, the PowerPoint presentation, as well as the recording. Any questions you have, just type them up in the little box, and as I go along, I'll try and answer. Just try and make the questions short and sweet, to the point, and obviously also make it context, whatever I'm talking about, or content rather, or related. Okay. So let's get into the nitty-gritties. This presentation, the webinar, is based on tutorial 7 on portfolio management. So you'll find it on our homepage before logging in. Click on the resource button and click on tutorials, and you'll find tutorial number 7. So obviously the idea here is for you to review what I'm talking about, just to entrench some of the principles and techniques we're talking about. Okay, so that's where you'll find it. So let's talk about portfolio management. Okay, we all understand that the fundamental analysis also questions what must I buy, whereas technical analysis is more the timing issue. It asks you when must I buy and when must I sell. So these are 2 essential analytical methods that you'd use to choose a share. But obviously there's also other approaches to the share market that focus more on strategy rather than analysis. So these are not alternatives to the fundamental and technical analysis. When I say alternatives, portfolio management strategies, these are not alternatives. They are there to be used in conjunction with fundamental analysis and technical analysis. So the reason why I say that is investing is far from exact science. You can do all the fundamental and technical homework, and you can still make some disastrous investments. And I've been there using fundamentals and the technicals. Sometimes something happens to the company out of your control. So the idea is that you want to safeguard yourself against financial ruin. Obviously, the whole idea also is to ensure that you have effective overall portfolio management strategy in place. Okay. So to get the main benefit or maximum benefit of a share portfolio, it's very important that you do some planning. Okay, so you don't just suddenly have a portfolio; you build a portfolio of shares. So it's not undertaken in a haphazard fashion. Obviously, you want to fit this all into with your financial needs and obviously your available resources. When we say available resources, on the one side obviously is time, on the other side is money. So there's no hard and fast rules. Obviously your choice of shares that you have in your portfolio, at the end of the day, we'll talk about the portfolio structure just now. You notice I don't give any tips, I'm sorry, but obviously it's a personal matter. So it depends on your taste, your temperament. When I say temperament, is obviously your risk profile, but also your own assessment of the company involved. So bottom line, a planned portfolio has a far better chance of success than a portfolio of randomly selected shares. Okay, so there's a process, there's a strategy in place that will ensure your success. Okay, so let's talk about risk management. I spoke just now briefly on your risk profile. Now I'm going to talk very quickly about the investor or trader or both. Ideal situation is to be both. To have an investment account, that's your long-term portfolio, your buy and hold strategy, and the trader is more the short-term income fund as such. So the idea is to split it up, have 2 separate portfolios. It's just easier from a tax point of view. Say to the receiver, this is a buy and hold strategy. Excuse me, capital, my trading portfolio. Yes, this is income, this is taxable. The main big differences as such, obviously investor, you're a passive investor. Your view is more longer-term, 3 years plus. Your strategy is buy and hold. Your aim is to find quality undervalued stocks, and your goal from a portfolio management point of view is to build a balanced portfolio, some financial shares, industrial shares, and some resources or mining stocks. Your goal always is obviously capital growth, but also dividend income or income from dividends, as well as growth in those dividends. If I buy and hold once and I don't sell, obviously I have low brokerage costs. And if I sell after 3 years, then capital gains tax applies, which is much lower than income tax. And all your dividends are paid out after the 15% dividend withholding tax. That's as an investor. Just gives you a quick overview of that. We'll come back to it just now. And obviously, as a trader, your view is slightly different. More time is involved. Active management, less than 3 years. Different styles of trading. We talk about day trading, swing trading, position trading. Your goal is still obviously capital growth. Buy, take advantage of the cycles. Buy when the shares are low, sell them when they're high. Alternatively, by using things like single stock futures and CFDs or derivatives, you can also take advantage of falling markets, sell high and buy low. But things of trading, obviously buying and selling, you'll have much higher brokerage costs. You have to take that in consideration. And at the end of the day, that income is obviously taxable. Okay, so I just wanted to highlight the differences, and we'll talk just now more about the risk profile. In the next slide, you'll see what I mean by risk profile. On the vertical axis, if I can just get my pen here, we got the reward, okay, and on the horizontal axis we got risk. So there's a trade-off between obviously returns and risk. The higher the potential returns, the higher the potential reward, obviously the higher potential risk. But you see that obviously I've got prudent as colored red, and that's the quadrant you want to be in. From an investment point of view, you want to be a prudent or wise investor. You want to go for high rewards or high returns, but at low risk. Some of you might be more aggressive. You want to go for more of the speculative stocks. You want to go for high reward at high risk. That's fine. But obviously, as long as you're controlling risk. And then the last one, you never want to be in this category here, what I call speculative. To me, it's just crazy to go for a situation where you have low reward but at high risk. That's just throwing money away. Okay, so this comes back to what I call about what I mentioned, risk profile. You need to ascertain where are you, where you want to be. An ideal situation will obviously be the prudent investor or the prudent trader. Okay. So what attracts people to the share market? Obviously the potential high returns, but obviously that comes at a price. As mentioned just now, the higher the return, the higher the potential reward. Okay. So they should work. They work together. The higher the return, the higher the potential, the higher the risk as such. Okay. So you should ask yourself the question: is the potential reward or return worth the potential risk? And secondly, what are the chances of me losing all my money in this investment? So when it comes to shares and obviously things like that, you want to buy into good quality stocks. They're not going to go bankrupt overnight. You know, they might be dropping, but you still got something you can sell. Whereas with derivatives, you can lose your margin plus more. So that's unlimited. So the degree of risk is obviously, it's a function of the probability that the actual return received will be less than the return expected. So the greater the volatility in the return, you should be expecting more downside moves. So it's just referring more to the derivatives. You understand that obviously these things come with a wealth warning. And obviously the higher risks. Derivative trading is not for the novice investor. You need to understand how the market works before moving into those things. But there are two kinds of risks in the market. We talk about systematic risk. That means the whole market will crash. Okay. I was reading an article this morning. They're talking about we're not in a bubble. Yes, the market is trading at highs relative to the price PE ratio, but we're not in the bubble. We've got a long way to go before we're bubble. And they were saying that we're only halfway through the bull market. But that's the systematic risk is if the whole market crashes. Our last crash as such, our financial crisis was back in 2008. So we're 5-6 years down the line now. So people always say the cycles of 6 years, yeah, maybe. But just being aware where the market is, that also just helps you a lot to minimize the risk. But more importantly, you also get what they call unsystematic risk. This is the risks associated with a particular company or particular sector or investment. Okay, so those are the two kinds of risks involved. So the returns do not really correspond to total risk. That's, when I say total risk, is combining the two kinds of risk together. It's returns is only applying to the individual company or the individual investment. So unsystematic risk can be greatly reduced by using portfolio managers strategies, more specifically diversification, I call it spread. We have systematic risk, the whole market. Crashing cannot really be reduced unless you use things like hedging and things like that. So you want to spread the risk around. We'll talk about it in more detail just now. So the challenge comes with having a big portfolio. Let's say you've got 20 shares in your portfolio. The challenge is come to a stage where, because the diversification doesn't really apply anymore because your portfolio is so big. It's very minimal, the effect of a big portfolio on your portfolio, having too many shares in your portfolio. Secondly, the returns will also tend towards the average. Some shares in your portfolio do very well, and some shares do very, very bad. So you get the average return of the portfolio. So that's a challenge of having a portfolio that's big and unwieldy. So the idea is to find a balance, obviously, between the number of shares in your portfolio to minimize risk, but also obviously you want to find shares that give you the potential growth or the maximum returns. Okay, so as I said just now, systematic risk can be hedged using things like single stock futures specifically, but also you can also use CFDs. You can also go into other markets. So we talk about asset allocation and things like that, allocating into different markets geographically. That's another lecture sometime. Okay. Let's talk about portfolio strategies. So let's talk about portfolio diversification. This is obviously the basic principle of any sound investment strategy. So it's a very highly effective method or way to minimize unsystematic risk in the market. Let's see if you put all your eggs in one basket, you want to spread your risk. That's what we're talking about here. So we mentioned already the two different kinds of risk. The whole idea is that it's better to hold several shares than having all your eggs in one basket. So you want to spread your capital among different shares as well as different industries. And you'll see in the slide just now where a suggestion, one of the portfolios I started years ago, that was the thinking behind it. So the purpose of diversification is to limit your risk or vulnerability to any adverse movements in a particular share or industry. You'd be crazy to have all your shares in gold, all your shares in IT. So you want to spread it between financial, industrial, mining and resources, for example. So that's the idea. But remember, diversification will not protect you against, obviously, the general market slump. If the whole market's falling, it means most sectors are falling. Most sectors are falling, most shares are falling. So that's why it's important to have investments in other asset classes, be it bonds, be it property, even going offshore into other equity markets. So this is where we talk about diversification. Where as you increase the number of shares in your portfolio, your risk will decline to a lesser extent. So, for example, if you had just one share in your portfolio, all your money in one share, obviously the challenge there is you get great risk that particular company can get into difficulty. So you got a chance of losing all your money. But now you're going to buy a second share. Now your risk is reduced by 50%. And as you add on, okay, this is where the risk is diversified. As you add on a third share, divided by 3 now, each share, the risk is spread 33 and a third. Add a fourth share, we go down to 25% risk for that particular company. Fifth, 20, and so it goes on. When you get to number 10, each share as such will be, the risk is 10% to the whole portfolio. It gets to the stage when you have 15 different companies across 3 or 5 different sectors. That's the ideal situation we want to have. I personally like to have 12 shares in my portfolio, but between 12 and 15, I'll say that to be the maximum portfolio to have. When you add the 16th share onto your portfolio, then the reduction in risk is very, very negligible. So a very important little exercise to do for yourself. Look at your portfolio and see how many shares I've got in my portfolio and where am I mainly invested in. So one of the disadvantages, obviously, with having a big portfolio is the research involved. So you have to allocate more time to all the shares in your portfolio. It's very difficult to keep abreast of the changing fortunes or misfortunes in a very large and varied share portfolio of 30 companies. So it takes a lot of time. So the smaller the better. You can also the growth and returns will be much better in a portfolio where it's focused or concentrated compared to a portfolio that's been watered down with poor performing shares. Okay. So there's a trade-off between risk and time. You don't want to have fewer than 5 shares, and obviously all your eggs in one basket. You don't want to have too many. Obviously, as I say, your portfolio becomes unwieldy, and obviously you won't be able to have enough time to research all those shares. Okay. Before moving on, let me just see if there's any questions coming through, the stuff we've been talking about. Yes, can hear you. Great. Okay, no questions yet. Great. Can you hear me? Okay, there's no real questions yet. Thank you very much. Okay. Okay, so this is just a suggestion. This is one of the portfolios I started a long time ago. When I say portfolio diversification, bring up my cursor again. It's along the lines of industry. So these will be, for example, all my financial shares, industrial shares. Those will be my financial shares. Those will be my industrial. So I'm spreading along the industry. But obviously within these different industries, you'll be looking at specific sectors. So when I talk about financials, that all include obviously the banking sector, the insurance sector, the listed property sector. Industrials, that's wide, from telecommunications to diverse industrials, etc. When I say mining, and this is also a contentious thing, I personally don't like to have any mining. When I say mining, it's your gold mines, your platinum mine stocks in a long-term portfolio because of volatility. But saying that, I do like my resources. I do have Sasol's in my portfolio long-term. I also like Billiton's. So that's what I mean by mining. Okay, but it's spread along the lines of different sectors and different industries. Okay. We'll come back to portfolio structuring just now, but you got the idea that you want to spread your risk between 3 and 5 different sectors, so you're not all your eggs in one basket. Okay. To maximize your performance, as I say, you want to concentrate your portfolio. So, for example, you got 100,000, 120,000 rand, and you're going to buy 12 shares. Basically, you put 10,000 rand into each one of them. You'll see example just now. I used 10,000. Very similar. So those 10,000s were what we call a portfolio unit. But obviously some shares will have a bigger weighting because you feel there's more prospects there. So you might double that situation where obviously you allocate 20,000 rand to that particular share. But just understand the higher risk of that company, so you might have a tighter stop loss if you're using stop loss in a long-term portfolio. Okay. So bottom line, you want to create what I call a well-balanced portfolio. And I really believe in having a portfolio that's very much skewed towards rand hedges. I believe that the rand, we saw the rand going over 10 rand 80. We're heading towards 10.90. We're back to 11 bucks. So you need to take advantage of the weaker rand. So you need to have some shares in your portfolio that is rand hedge orientated, either manufacturers or exporters or operations offshore. And there are a lot of them available in the market. Okay. So just selecting one sector can also be very risky. So that's why you want to spread it. So you want to look into sectors that are healthy and obviously fit into your overall investment strategy. I like the mobile telecommunications sector. I like the MTNs and Vodacoms. And there's a lot of convergence there with technology and media. So I think there's a lot of growth prospects there. As I say, I like Sasol. Not so much being an oil company, it's obviously a rand hedge stock. That's more important for me. They do better when the rand weakens. It's not so much the oil price, but also the intellectual capital company. That's the way I perceive them. They can change gas into liquids or coal into liquids, and they can use that technology anywhere in the world. So that's what I like about it. So one of the biggest problems when it comes to building a share portfolio, and obviously the whole presentation today is more skewed towards the investor than the trader. There'll be other times we talk about trading. But from an investment point of view, the biggest challenge for most private investors, they do not have sufficient capital to establish a well-balanced or well-constructed portfolio. They might only have a little bit of funds and obviously allocate more funds or ideas. This example, you got 10,000 rand. Instead of bring all your money into one share, you maybe want to buy 4 different companies, 2,500 in each, but obviously your costs will be much higher. So that's a challenge with starting a small portfolio. And then as you obviously grow and add more funds to it, you can obviously increase that. So that's the one side. The other side is also it's considered too risky just to jump into the market. And I was reading an article this morning about people jumping to the market at these levels. I said just now the markets that are trading on an average about a PE of 18. There are pockets of value in the market right now, but I always look at what's happening with the general market trends first, what's happening with JC All Share, and then from there chunk down into the various sectors, be it the resources, mining, financials, and then from there into the individual sectors. Okay, but the idea is to build a portfolio over a period of time. You don't just suddenly have a portfolio. So it's being patient. I think that's one of Warren Buffett's qualities. He is a patient investor. He sits and holds, but also he waits and does his due diligence on a share before buying into a company. So when you're actually building this portfolio, always take time out to review it constantly. We'll talk about in the next slide how often. Obviously, you want to keep watching prices. Obviously, as an investor, you're going to be watching it minute by minute. But you want to be kept up to date with the shares in your portfolio, but also the shares in your watch list. So the more you know about a certain sector or industry or share, the better. Okay. So when I say review, some people like to watch it once a week. I watch my long-term portfolio once per month, and then obviously I tweak it from there. You ask yourself a whole lot of questions, and those questions always must be based on facts. The distribution of sectors and shares in my portfolio. Does it still take to my investment strategy? Is the share portfolios, the performance of the individual shares in line with my expectations? How does the latest information alter my expectations? And if there's any action required, yes or no? Most of the time, just leave the portfolio alone. If you've done your homework right from the beginning, the fundamentals and technicals, and you structure your portfolio, and you slowly built this portfolio over time, there shouldn't be any reasons for you to change it. But obviously, you want to be alert to any rustling in undergrowth, or what I always say, the smoke, there's fire. So either gives you a buying opportunity to buy more stocks, or you want to get out of that stock. So always be aware of those shares in your portfolio. So also, I always believe in having some degree of liquidity, have some cash available in your portfolio. You'll see in the next slide. I always like to have cash available, because if you're 100% invested, an opportunity comes along, and you're forced to sell one of your shares for the wrong reasons. Okay. Obviously, there's also other little dangers. You can become too attached to a particular share, and I know I do become emotional about Sasol. Sasol has treated me well, but it's still a great company. I still think it's undervalued, and I still think it's profitable. That's why I'll always hold it. It's been good to me, but I'm not too attached to it. The idea is also never compare the current share price to what you bought it at, because that can distort, obviously, your perceptions and things like that. The best thing to do is forget about what you bought it at. And I know I've had Sasol in my portfolio for many, many years, and obviously you see the profit you're making on that share. So what's more important is the valuation. Is the share still offering opportunities from a growth point of view, a valuation, whatever the case might be. Okay, let's move on to portfolio structuring. It's very similar to diversification. This is adds another dimension. On a spread my holdings now across different market sectors. So, we spoke just about diversification, three or five different sectors. Now we're just adding another dimension. Now we're looking at the quality of those stocks as well as your time frame. So, what's important here also is to tie the two together. Your main objective should always be to minimize your risk. There's also on the other side of the coin, obviously you want to maximize your return. So there are limitations, as I mentioned just now, the amount of time you can afford to spend on analyzing the companies, and obviously the amount of money that's available to invest. So it comes back to what we talk about security. As a young person, you have your whole life ahead of you. Obviously, you make mistakes and things like that compared to a person nearing retirement. You can, the younger you are, you can start over again. So obviously, you can take on higher risk when you're younger. Well, when I say higher risk is calculated risk. Okay, but have different time frames, and obviously looking at different quality stocks and things like that. And the easiest way to break it down is when I talk about blue chips, green chips, and red chips. Blue chips the expression comes from the good old days on the casino table. The guys used to play blackjack or poker. The biggest chip on the table was a big blue chip. So that usually refers to a company's been around for a long time, at least 5 years. A consistent growth in the earnings, consistent management or good management, and a whole lot of other stuff. Green chips, those are the growth stocks, the companies that are still newish. They're not paying out a lot of dividends. They're reinvesting everything back into the business, but the growth is great. Obviously, much higher than 15% plus. That'll be my benchmark. But they're not. Sometimes they're not cheap from a valuation point of view. Your famous brands and all those kind of companies will be considered as a growth stock. Same as the Naspers. And then we talk about the red chips. These are the speculative penny stocks. Anything that's under the radar screen out of the top 100, I'll classify as a small cap stock. So just highlighting, obviously, red being more riskier. So there are good quality small cap stocks. You still do your homework. You still want to go for companies that are undervalued, profitable, manageable risk. And there are a lot of them available, even on AltX. But when it comes to these smaller companies, you want to look for cash flow. You're looking for interest cover. So you're looking at the quality and the safety in those shares. Okay, so the main idea, as I say, is to minimize risk. So having a blend between all the three different kinds of stocks, you'll have a safe long-term portfolio, but also a portfolio that's going to give you some medium-term growth, but also in the shorter term, obviously higher risk companies will give you the kickers as such. So going back to what I said just now, you might allocate at least 50% of your portfolio to the large cap stocks. When I say large caps, these are the top 40 stocks. And on our website, you'll find a list of those top 40 stocks. If you click on indices and then CFD list, and then take that list and copy it and put it into Excel, and then just rank it by 15%. Those will be your top 40 stocks. The next 60 companies in the top 100 will be the mid-cap stocks. So you might allocate slightly less funds, or 50% or 35% of your funds to the mid-caps, and you might allocate a bit more to 15% to the small caps. And you see in this sort of diagram here, I always believe in keeping 10% in cash. But you can see there's 12 shares, and we're still diversified along the lines of industry, and you can play around. This is just a suggestion. 12 companies is what I always like to work with. 4 large caps, 4 mid caps, 4 small caps. But you can have 8 mid caps if you want to. You'd rather go for better quality. I like to go for companies that are also paying out high dividend yields, have high dividend yields, so I can take an additional cash, additional dividends, or cash from dividends, and reinvest it and plow it back into my larger portfolios. So I've even started a portfolio just from the dividends from a portfolio. I started a separate portfolio. So there's various ways of doing this. Okay. Then lastly, obviously, the stop loss. Remember, again, your fundamental objective of portfolio management is to limit risk. Now, this is a question you need to ask yourself. Will I use a stop loss in a buy and hold portfolio? I personally don't. I use other things to hedge myself, single stock futures, or I use the diversification. I prefer to use stop loss for trading, but the idea still is to have some kind of risk management in place. Okay. This only comes through experience, and that's either from investing on the market yourself, or from attending webinars like as you start formulating opinion, should I use a stop loss or not. But basically the principle is to limit the risk to a tolerable loss, be it a percentage, and on the next slide we talk about it. As a quick example, I've got my analysis, I've done my fundamentals, done my technicals, I've got a signal to buy 10 Rand. The first question you always have to ask yourself is how much am I prepared to lose? Let's say you decide on a 10% stop loss. So 10% of your purchase price of your 10 Rand or 1,000 cents is 100 cents. So you value the shares down to your stop loss level. So the idea here is to eliminate human emotion. So greed and fear are the two biggest enemies in the market. So I'm not valuing the market at current price. I'm valuing the market at the level I'm prepared to sell it. So it's helping me to become objective. If the price drops to my stop loss level, what you're going to do? You're going to sell. Okay. One thing you must admit is that your timing was wrong. Okay, that's the way to look at it. But the idea here of the stop loss is that you're minimizing your losses if the market goes against you. Other side of the equation, if the market goes up like you anticipated, your stop loss now acts like a ratchet. And in this situation, two things. I'm using this more for equities, and secondly, also I'm talking about a 10% trailing stop loss. So as the price moves up to 13 to 15 Rand, your stop loss is still 10% of the current share price. So you value the stop loss will value your shares down to 13.50. So we're still 4.50 Rand up from our previous stop loss. So our stop loss is a bit higher. So yeah, we're minimizing our losses. Yeah, we're riding our profits. If the price drops to 13.50, 150 of that, we're out of the market. We're still locking into profits. Goes to 20 Rand, we still 10% of that. We're down to 2 Rand, down to 18 Rand. If it drops to 18 Rand, we get out. So stop loss works this way, that we're minimizing our losses, riding our profits, and maximizing our returns. That's the idea behind it. What's very important is being disciplined and to apply it. Okay, so this is where the secret lies. So there are brokers out there that will accept stop losses. Most of them will be using it on a system that's automatically implemented into the market. PSG Online, our website, does offer that. There's one very important principle to understand about stop loss. It can always be moved up. In other words, I can drop it from moving from 10% back to 5%. In other words, I want to make the losses smaller. But it must never be widened. Never go from 10% to 15%. So always stick to those rules. And remember that the idea is to contain the risk. Okay. So if the price rises above the purchase price, you'll hold it. And such time is that the market pulls back to your stop loss. And then obviously you adjust the price as it goes up. And that's where I use the example of the ratchet. Okay. So here's a scenario. Here's Anglo's. This is yesterday's closing price. Anglo obviously gapped on Monday, gapped down, and then we touched our 33% retracement level. And then yesterday we bounced back again. But if our previous resistance will become support, together with our retracement level, you might anticipate good time to get into the market. Now, from a trading point of view, I'd like to put a stop loss. I find my stop loss by looking at the chart. So I'm looking at that 33% retracement level, that 254, as my stop loss. Okay. So that is from a trading point of view. But from an equity point of view, yes, this is an equity portfolio. You can see here's my equity account. Here's Anglo's this morning. So once I've bought the share, I come back into, I go click on new order, come back again, and I click on what they call a price watch. Okay, your price watch acts like a trigger. So yeah, I'm using a 10% trailing. So I select trailing, and that's 10%. So obviously 10% on the current share price of 257 is 25 Rand 70, whatever it is. Okay, so you must calculate from there where if the price drops, what will happen. But it's also very important that you put in a stop order. Stop order is a bullet. So I'll calculate 10%, and I'm calculating roughly at 231. 231 is the worst case scenario price. If the price does drop 10%, 25 Rand 70, it's going to trigger, it's going to go into the market as a potential sell order. Okay, that's how a stop loss on our website works for equities. But with CFDs, you'll see that the trading stop loss will not, it is there, but it's not available. Yeah, you stipulate a price. Going back to my graph just now, I might say, okay, 254, that price, that retracement level will be my trigger. If it drops through that, get me out. And my very important close me, if it does get to that situation, and slightly bit lower, I'm just taking 50 cents lower, that's the worst case scenario. Where would it trade? At 254. Okay, so that's how a stop loss will work on the system. Okay. Let me see if there's any questions coming through. I hope you guys are enjoying this. Let me go back here. There's a question here from Dietrich. How do you see these work? I think I'll answer that the email to you. Very similar to shares, obviously. It's derived on the underlying share data, but the big difference is the geared product. You just need to put it down a margin. A deposit of 15%, so it's a geared product. It works very much similar to a share. So it's this capital efficient. There's a question from Flip. Flip, kan ek Afrikaans praat? Ja, kan, maar nie op die webinar nie. The mark is hard enough in English. So, sorry, the majority of people on the presentation do understand English. If you don't understand me, you can always send me an email and I'll explain it to you. Andre, question here. When diversifying, would you invest the same amount of cash in each or the same shares that you take on? Yeah, that's I think I've answered just now. It's up to you. You know, I might allocate, you know, you saw just now 100,000 Rand. I'll allocate 50% to 4 companies. So roughly about 12.5% to better quality stocks and less funds to more riskier stocks. That's one way. Alternatively, you want to have 10 stocks in your portfolio, you've got 100,000 Rand, allocate 10,000 Rand to each. So each one's equally weighted. You need to decide for yourself. And also, thanks for bringing it up, Andre, I always suggest that you structure your portfolio on paper before actually buying the share. Okay, building the portfolio. Just structure on paper first. Okay. Question here from all the shares I've mentioned are very expensive. Okay. Expensive from what point of view? I know Sasol is trading on a peg ratio of about 85, which is still considered fair value. Remember, a 500 Rand share can be cheap relative to earnings, and a 50-cent share can be cheap. It can be expensive relative to earnings. So there are opportunities in the market, but obviously you need to do your homework. Penny shares, this is a question here from Mr. Van der Merwe about Sintova. I don't know much about it. I have to do some analysis, come back to you. Okay, there's a lot of questions about CFDs. I'll have to come back to you guys. Okay, let me just wrap us up quickly before going on. We're at the end. I've run out of time again. So I hope you guys enjoyed it. They found it beneficial. We got 2 more webinars the rest of March. Next week we come back to technical analysis. We talk about cycle theory and trend analysis. Very simple, very basic technical analysis. But that's my foundation to my analysis on the market. If you're going to identify what trend are we in and be on the right side of the market, you'll be making money. And then obviously the last one for the month will be fundamental analysis. We start talking about financial statements, more specifically the income statement and all the financial ratios around it. So the idea that you'll be able to understand an income statement as an investor. Okay. Those of you in Cape Town, I just did a traders forum last night in Pretoria. Those of you guys that were there last night, thank you very much for your support. We had a full house, and I really appreciate the support. I hope you also enjoyed the snacks and drinks afterwards. But you guys in Cape Town, I'm coming to do the same presentation down there. Obviously, I will polish it up by then. You'll have more information, but I'm talking about technical analysis and trading. So that'll be on the Tuesday, the 25th of March. Okay. So as we do with every presentation, this presentation will be sent out to you together with the recording. Go online also, go through the online tutorial. There's a lot of other stuff I haven't mentioned regarding portfolio management. Any questions you have, please post them on our Facebook or Twitter pages. But also use our watch list to help you structure a portfolio, to help you find the shares that are undervalued, profitable, no financial risk. And then use that trailing stop loss, especially on the equity side. Well, even those guys that are involved with CFDs and single stocks, use the stop loss available on the platform. The idea is to minimize your losses. Okay. And obviously, lastly, good luck and happy trading. I hope you've enjoyed it. Here's my contact details. Those of you who haven't answered your questions, those long questions, I'll be answering you with email this afternoon. But thanks a lot. I hope you've enjoyed it, and thanks for your participation. Enjoy the rest of your day, and all the best. Keep well. Bye-bye.